Afternoon. Thank you for joining us on this day after the holidays. Seems like it's going very quickly, but thank you again for taking time out of your day. As always, if you have questions, raise your hand and we can unmute you and let you ask them live, or feel free to type something in the little chat feature and we will read those at the end of the presentation. Anyways, Dave, it's all you.
Okay, great. Thanks, Jen. Hey, welcome again. And I'm always excited about talking about the greats. And I don't know why, but I think it has something to do with the fact of starting off in this industry. You're just struggling to try to find mentors and good advice to try to follow, because there's so many different moving parts. There's so many things out there. And I read everything that John Templeton wrote. I mean, every quote. And and it wasn't just reading every quote. It was just like really thinking about everything he said, and everything that Peter Lynch, Michael Price, Warren Buffett, all the others, it's just like, wow, this is so good. In thinking about it, and it really impacted me. And so when I think about what they all did long term in investing, is one of those things that it helps center me, keep my thoughts in good, solid foundation rather than being emotional. And that's one of the threads through this as we go through this quite emotional time. It really is a question about leadership, a question about inflation, a war. Where are we going from here? The country's on the wrong track. Consumers aren't confident. Business isn't confident. Interest rates are rising, and there's a lot of cross currents out there, but the world's opening up, or is it? And then the tech companies coming out are blowing up. Some of them are down 90%. I mean, incredible numbers. And so it's a really tumultuous time. And I think for all of us, we get into these, and it's just good to focus in and think about some of the core concepts. Yeah, this is long term. Yeah, I'm in for the long term. All of those things, but we have certain indicators. And I'm not making fun of anyone. I'm really just saying this is really interesting that some people are perfect indicators of market bottoms, and some people are perfect indicators of market tops. It's when they want to buy in. So it's not that they're intending to do this, it's that their emotions reach a point where they just feel like it can't get better. So I have to say at this point, and this is certainly not to say, wow, I was right. It is only to say, this is what happens every time. When we are at a point or a peak of pessimism, as John Templeton always called it, then somehow we get these bounces. And I'm not saying this is a bounce off the bottom, but certainly last week, 6 to 8% on the major indices is quite a bounce. And it came out of nowhere. And it's really an important thing to remember that markets don't move in a straight direction. They don't move for the reasons everybody says. And they just kind of have their own way of moving around and proving most people wrong most of the time. And so it's a great reflection for all of us. And I've got a lot to add to all of these quotes. So let's go ahead and get those started, Jen. And I really like these. I like all of these, right? But one of the things that we always find is that the market is telling us why every single day the market is doing something. Like why is it up a few points or down? It's inflation, it's oil, it's this or that. And it's just absolutely not true. And people have these. They're always trying to say things like, the S&P, we look at 3,400 on the S&P, we were at 3,800, but blah, blah, blah. Earnings are this and that, and they take these multiples. And the truth is that everybody's wrong. And I really like the way Peter Lynch puts it. It is funny, of course, but There's thousands of experts, and they really are, and they're studying these overbought or oversold indicators and all these goofy charts. You know, it's like, well, there's a head and shoulders thing, or there's a death cross. The Hindenburg one is a great one, right? And maybe they're right once in a while, but honestly, they're absolutely useless. They're as useless, if you will, right? As he says, the gizzard squeezers and the Roman emperors, they couldn't guess. We all want to predict the future. And I think the point here is that you can't. And you really need to not do it. Warren Buffett puts it real succinctly: I make no attempt to forecast the markets. None. Why? Why would Warren Buffett have no opinion about the market? Because he's a very wise investor. Markets will prove you wrong all of the time. And all of these forecasts of 3,400, or is it 3,800, or are we going to rally from here, are completely to sell stuff to viewers. Meaning we can't talk about anything for all the hours of the day on CNBC. So we can't sell advertising because nobody's really that interested. So we've got to make up stuff all the time. So Joe Jones over here on Wall Street, why are traders doing whatever, is completely wrong directional. And it really is, as Ken Galbraith, I love the way he puts this, right? The function of economic forecasting is to make astrology look respectable. And that is true, and draws us back to this whole point with economists that you look at and you go, my goodness gracious, economists are wrong about one simple indicator more than a coin flip. Wrong more than a coin flip about the direction of interest rates, and they have been so for the last 20 years. They're wrong 60% of the time. I believe last time I heard that a coin flip is 50-50. How is it possible to be able to study everything and you still can't get interest rates right over the next 6 months? It seems amazing. And yet we breathlessly wait for the economists to speak and tell us what the future is going to be. And they can't. They simply can't. And the sooner that, you know, the striking thing is the sooner that we get our minds wrapped around that we simply cannot predict the future, the better investors we are, the happier we are, the more humble we are, and the better decisions we make on everything in our life, because we simply aren't trying to predict the future. I know I'm always at, what's the market going to do? What do you think about the market? It's really not saying, oh, don't ask me questions. When I say, I don't know. I know that the market will fluctuate. I know that we will have corrections periodically. They're certain to occur over and over again, all the days of our lives. And unless the world starts shrinking economically, and I don't mean recessions, I mean in the long run, like we're not growing anymore, a highly unlikely event, then the markets will then again hit all-time highs, because that's what we do, is creative destruction. That's what we do so well in the United States. We do it so well. Let's go ahead and take a look. And then here's what people want to do. And it feels like you can. It so feels like you can, right? Because in hindsight, it's really clear that inflation was a bigger worry than people had at the beginning of the year about the inevitability of inflation. It didn't just start up after the war. It was already there. The Federal Reserve promised on this day, on the calendar, we will start raising interest rates. And here's what we're targeting over the next 12 months. Market just kept rolling. We don't care about that. But now all of a sudden we look back and go, well, yeah, we should have sold out everything on January 3rd or whatever the high date was. I don't really remember. It was early in January. So we can't do it. But I like the way that this puts it, right? Far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. And John Bogle, he was not exactly soft-spoken. He really said what he believed. The idea that a bell rings to signal when you get into and out of the stock market is simply not credible. It is not credible, period. Not looking online and say, but this guy called the last drop, this guy called that one, this guy called that one. That's to sell you garbage. It is. And to hear people, yeah, the market's overvalued or whatever. You know what? The market could be overvalued for the last 10 years. According to the Schiller Index, it was. For 10 years, should not own stocks. Boy, what a great call. Boy, it really made people a ton of money as the Dow ran from 5,000 to 35 plus. Really great advice. Super great advice. It is not credible to time at all. After 50 years in the business, I don't know anyone who has done it successfully and consistently. And this is a line I love. I don't even know anybody who knows anybody who has. They don't exist. Like they literally don't exist. Market timing, you might get one right. You can't do it consistently, and you might not get it right. So as we look in hindsight, everybody knows fill in the blank, and everybody knew fill in the blank, because we all look back with perfect 20/20 hindsight, and we always do that. And we have this, if you will, propensity to believe that the feeling we had is a unique moment in time that I should have sold out. I knew it. I felt it. I felt it at the beginning of the year that the market was too high. All right, whatever feeling we have. And we're never really honest with ourselves about those feelings. And of course, I have my own personal stories of, walking in one day and telling Jennifer, this is back probably 5-6 years ago now, walking in and saying, this market is absolutely pathetic. It's horrible. It's never going to get better. I'm telling you, it's just absolute garbage, this market. I wouldn't be surprised if it crashes. And that was on a Wednesday. And I'm literally in my recliner, chilling at the end of what was a long week at that time. And all of a sudden it struck me at like 9 o'clock at night. Bam! You were about to sell out on Wednesday, or your feeling was the market was going to tank. It was so bad. The trading was so bad. By the way, roll forward. Thursday up 600 points. Friday up 400 points. Out of nowhere, for no reason. I'm sure everybody had a zillion reasons why this was absolutely certain to happen, or it did happen because something out there. Nothing happened. The market got tired of falling. It didn't fall apart. It went up 1,000 points. I wasn't going to sell because I have experience, and I'm just not going to do that. I have experience, and I'll go, oh my gosh, this is so sickening to me. I think I'll sell today. No, it's not that. The point is that I was dead wrong, like every other human being is dead wrong. We just don't remember it. And by some lucky miracle, I'm sitting there and I remembered it. But we don't remember all the times that we felt like we should sell. And then finally, like a stopwatch, you're right. It's not right. And that's that again, that human feeling that we're right more often than we think. Or we think we're right more often than we actually are. I said that completely backwards. And so we are dead wrong about a lot of things, a lot more than we think. It's important, if you really think you're really good about timing the market, to remember people like John Bogle don't even know anybody who knows anybody who's ever been a good market timer. It just can't be done, no matter how we feel, no matter how we feel. So let's take a look at one other thought here, and then I want to share some recent data with everybody and kind of what we're thinking about, okay? A market correction is an opportunity. It is. And the reason I wanted this slide is I want to get in the weeds just a little bit with you after we talk about some of this. It really, if you really were thinking about it, market downturns are a credible opportunity. I use this example recently a lot, okay? And it's not an appropriate stock for most people because A, it's super volatile, B, it produces no income, and that's Amazon. Now, I like using stocks that people, A, are real familiar with, because we all are, right? And also use their services, right? Because people do. A lot of people do. Most people do. Now, Amazon recently was at 3,800, $800 a share, dominating the world. That's its 12-month high, having a nice run. It recently, as of, I believe, a week ago, hit $2,020 a share. Today, it's at 24 plus 100, up 20% off the bottom in a week. These are things that happen quickly, but nobody wants to own it when it's down to 2,500, 24, down to 2,000, and everybody wants to own it when it's at 3,500. It's a very emotional truth. Wouldn't you really rather, upon reflection, own it at these prices instead of the more expensive ones? Of course, that's true of everything in our life. But the emotions of stocks and the pricing of it every day really throws us off. It really throws us off. And what we really need to be focusing on is not ever trying to time the market or being emotional about it or worrying about downturns. That's natural, don't get me wrong, especially if you haven't been through it, and especially if you're retired. There's no doubt about that. But what it also does at this time, it's really strange, but you know, I know this is kind of sounding like it's into the weeds a little bit, but I need to have you understand something, because it's completely backwards to anything else you would think about, would believe in life. And that is, we get better, lower risk deals when the market is volatile like this. It makes no sense. We can actually hedge trades cheaper after the market has fallen. It doesn't make any sense. I mean, it makes no sense. And our upsides are much better than they were before, not just because the market's down 15%, but because the deals coming from a down 15% are even better. In other words, you get a better deal when it's demonstrably less risk. Now, I'm not saying that there isn't risk it goes down more than 15, but I will say 15% on the S&P, 30 on the NASDAQ, that's where we're at. Hey, this is a discount. The market is demonstrably less risky than it was before because prices have already declined. So now we can go out and get better deals. It makes no sense. So normally when we don't have this kind of volatility, we would have some hedged things that would normally have an upside potential of 10 to 12% over a 1-year basis. In other words, if a market goes up 25%, you only get 12 or whatever the number is. If the market goes down, say 5%, you lose nothing because there's a 10% buffer on the downside. If the market goes down 20, you lose 10, not 20. Okay, so some people like that because, you know, it's a little bit of a buffer. Now, believe it or not, last week they just repriced one for May, because there's one every calendar quarter or calendar month. And so we go along and we go, okay, so here's the May one. It came out with over 20%. Same downside protection. This is after the market has fallen almost 20%, by the way, at the time of this pricing. And now you get a 20% upside, double the deal. Same downside protection, double the upside potential is a head scratcher when you think about it. It's completely opposite. In other words, I get more return for less risk. Odd. So we really should be embracing these bear markets. And when we get in really out of the weeds, we talk about notes and all the things we're looking at, closed-end funds, all those things that you will see some of in your portfolio. The buying time opportunities are unbelievable. Unbelievable. Bonds are looking even more attractive. And so you could actually see, if you will, risk go down in a portfolio and return expectation to go up. Crazy, but that's actually why we should be welcoming these types of corrections. You get a better deal. And that's the weird thing about this. It is such a strange thing that you actually do make most of your money in a bear market. You just don't realize it at the time. No doubt. And it's not just buying individual high quality companies. It's also because of this crazy world of derivatives and things like that, how the pricing mechanism works in that. with fear, greed. It's absolutely stunning. And it is just, I can't believe when we enter times like this and just sit back and go, what am I missing? How can we get such a good deal when actually it's lower risk? It's because the feeling is it's riskier when markets go down, not less risky. I mean, obviously the market down 15% is now 15% less risky, but that's not how we feel at all. Okay, so let's roll on to some of our other thoughts here and what we're kind of kicking around here. And again, this right here is just, I know you've seen it. I know you've seen this chart a zillion times, but it's always a good idea to reflect on the idea that you're going to sidestep a little bit of a bad market, just going to step aside just for a little bit. And the answer is you can't, because you're going to miss some good days. And when you miss just a few good days, as you can see, and this is no short period, this is 20 years of trading, 20 years, and you miss only 10 days, you've about cut your returns in half. But you really have more than that, because of the compounding effect of interest rates, it's actually is less than half the dollars just left in there, blindly following along, la-di-da, I really don't care what the market does, blah, 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 right? Those people that just put their head in the sand and they just don't really know what they're doing. That's an amazing chart to me. Miss 1 month of trades and you're at zero, basically, effectively. It's an incredible chart. But here's one thing I want to add. And that's this. People think, because automatically we all think, well, yeah, I know, I get it, but what about, you missed the 10 worst days, then you'd kill it. Well, 7 of the 10 best days occur within 2 weeks of the 10 worst days. Yeah, you're going to trade that. You're going to trade out, but you got right in on last Friday at the bottom, 2 Fridays ago, excuse me, and rode the market up 8 or 9% from the bottom. Yep, that's what you did. Nobody did it. Nobody can. It happened out of nothing. No matter what Wall Street says, it happened out of nothing. It's not because they suddenly felt the Fed this or the governor said that. The Federal Reserve is off doing something else here. Joe figured out a new energy policy for us all. No, none of it. None of it. It's amazing. Just amazing. So that's one of the things we always remind ourselves and remind you. And here's one of the things I've been thinking a lot about lately, and I mean a lot. I'm worried just like everybody else. Totally worried about things just like everybody else. How can we not? And so as we look at everything going on out there and we worry about, and you've heard all this, right? Like not just interest rates high, inflation's running crazy. We all know all those problems, right? But now you're coming along, you're saying, what's going to happen in the real estate market? I mean, last week, maybe it was a week before, whatever, 10 days, within the last 10 days, we have had a terrible housing number. 17%, okay, 16.8, sorry, I rounded up, is how much housing sales, existing housing sales fell. That is an astronomical number. That is like, boom, the brakes came on, right? From a red hot market, not totally reflected in prices now, but now you look at even here in Ada County and look at the number of homes that are on the market, and not on the market for a day or a weekend, on the market for a long time. Still not sold. Drive-by subdivisions, you'll see prices reduced. When did we see that last? Bam, big change. I don't think that's a problem. I think it's actually good to slow down housing. I really do. I think it's out of control. Prices are keeping people out. It's just craziness. So I don't see that as a huge problem, but it's another data point that we are slowing down, certainly in speculation. Okay. But the other piece that I want to say is this: consumer confidence and business confidence are really hitting some lows here. Super lows. I know it's a super busy chart. Don't worry too much. But what you really want to see is that box up at the top. Okay. When consumers' confidence peaks, like, man, everybody's super confident, the market doesn't do very well afterwards. Okay, it's only up 4% during from the 8 peaks. But from the troughs, in other words, where consumers aren't confident, the market can't possibly go higher, is completely opposite. Completely opposite. I think it's a big deal to reflect on that. So the fact that people are like, well, consumer confidence is really terrible. They did this survey, we're hitting new lows, and they are. People are not confident. It does not translate into Amazon not being able to rally from yearly lows. It doesn't translate into Apple not making a profit. It just simply does not. Consumer confidence is an interesting thing to talk about. It's a good political guidepost, and it most certainly is, because when politicians aren't doing a good job and there's not confidence, that's a problem. The thing I will say to this, though, that I'm watching very closely, and that is business confidence is hitting multi-year lows. It is really in the toilet. It really is. And that's where jobs are created. That's where expansion happens. It's where the economy booms. It's not the big companies, it's the little companies nobody's heard of. It's the Petso Financials, if you will. Okay? It's all of these little companies from 5 to 25 to 50 or 100 employees. Are they expanding or are they contracting? And if there is no confidence, they're not expanding. Let's keep our eyes on that one. That is a problem when we talk about confidence. But consumer confidence is frankly, is a pretty perfect counter indicator. There's not much that's perfect in the stock market, believe me. There's not, that makes it a perfect prediction. But the reality is we're dealing with a market right now that's saying consumers are not confident. I don't know how you could be, right? We have a vacuum of leadership, and I'm not going to run down that road. We all know what that feels like right now. And it doesn't matter if you're a Democrat or a Republican. There is not a feeling of confidence in the leadership, okay? So what we have is a lack of confidence generally. The consumers are not going to turn around and say we're really confident, but apparently they're still spending money. And now we're swinging more into services, which is good, away from goods, which is inflationary. Okay, services get cheaper and cheaper. They certainly do in tech world. And so what we're really seeing is a better outlook for inflation on that front. So again, I am watching that one, but don't pay attention to the consumer confidence. In fact, hope it gets worse, okay? Because that is a strong, strong indicator going forward. So with that, I think we want to basically say we temporarily hit a peak of pessimism. There's no doubt in my mind a week ago that we did hit a peak of pessimism. But it doesn't mean we're off to the races at all. There are so many functional things out there that we do need to watch for, to be cautious about. And so again, we continue to be, if you will, just sifting through what's in front of us, not reacting, but letting the markets tell us what to do. What you're going to be probably seeing going forward is you're going to actually see some opportunities in bonds. I alluded to that earlier. And this is something that happens every few years, where what's called credit spreads, I'm not trying to use too much of our own vocabulary here, but what that really means is that outside, the government has no credit quality problem because they're just going to print the money and send it out, okay? So that's the zero credit risk. Now you get companies like JP Morgan, the big banks that have gobs of cash flow, everything's good. They're high quality borrowers. So the credit spread's really tiny. And then as you get out on the curve, so to speak, which is the risk of those corporations, high yield, junk bonds, whatever you want to say, those get higher and higher. So for a while here, we've had this very low, if you will, credit spread, even in risky bonds. Don't own them, can't own them there. Now it's jumped. And let's just say this is the average. We're above the average now in credit spreads. And there was a time, actually last week, they closed markedly. Again, kind of with the stock market rally, or people thought the world isn't ending. So those spreads really narrowed up a little bit. As they widen more and or interest rates rise, we're going to see some more opportunities out there. We have dipped our toe into municipal bonds and closed-end funds. Again, sorry about the vocabulary, but there's some discounts there. We'll come back to those if we get there. We are getting there. We may not get there. where they're really great bargains. But you're going to see some of those. The market just dictates, and we change with it. We don't react in a panic. Oh, we got to go to bonds because whatever. Again, that's predicting the future. And if these great, wise investors don't know what the market's going to do, can't predict the economy, all those economists can't predict what's going to happen, let's not think we can. Let's just relax, go along for the ride, and try to get the big picture. The best we can to relax. And if I know you're nervous, who isn't? And especially if this is your first rodeo in retirement where you've got that pile of money that's moving up and down, even your second or third one of those, and that's supposed to have cost of living adjusted income all the days of our life, no matter how long we live, it's hard to have clarity. That's what we're here for. That's exactly what we're here for. It's why we have a job. It's not to pick the best performing companies. Sure, we can find and sift through a lot more data, and a lot more information is brought to our attention, and we know a lot more about some of these other areas of the market than you do. But that's not what it's about. It's about keeping our heads, looking for opportunities in a down market. If you need to talk, we need to hear from you. And that's really part of our message is don't worry, but don't worry. If you are worried, then talk. And there are many, many things out there that we can do and shift things around and feel like you've done something to empower yourself. We're doing that if we feel it's necessary. I don't think it's necessary, but if for you, it helps you sleep, that's what we need to be talking about. We're not going to let you run off a cliff, or at least we're going to try. We'll try to get in your way if you're going to run off a cliff and say, sell it all, here we are. And I have clients, we do, they're great. They're absolutely the best bottom indicators that there are. They absolutely every cycle. Well, don't you think we ought to be doing something different? Yes, we do. We should, Bob. What we need to do is turn the flipping TV off. What we need to do is we need to quit going onto the dark web and thinking that there's something else materially going to go wrong. Until it's over, it's over. And if we have a nuclear war, I don't know how to manage around that. I just don't. I don't think anybody honestly does. So the reality is we just have to continue to look for the opportunities that come. And those opportunities, then we simply slide in with, okay? And finally, let me add this for those of you drawing an income. I've said this a zillion times, I'll say it again. We plan for corrections. They're not unexpected. We don't need to have a reaction to them because we're planning for the income 3 to 5 years out. That's how far out we have to be. When times are good, we plan for when times are bad. We have to. We always have. With that, let's go ahead and grab some questions, Jen.
All right, we have one already.
Okay.
It says, we heard something about a government bond that pays a constant 10.8%. Is that anything worth thinking about?
Absolutely. Throw 10,000 at the Treasury Direct. Thanks for mentioning that. It does. You need to hold it 5 years. So if inflation pulls down, it'll be just like it was a couple of years ago, a really crummy thing to do. And you can only do 10,000 per individual. So a household could do 20, but you have to do it Treasury Direct. So you have to go online. I think it's under the savings bonds. Isn't that the category it is?
I would search by I-bonds, and I believe it's 9.62, and it does reset every 6 months. So it doesn't mean you're guaranteed 10.8. I haven't heard it that high.
I haven't either. That's a good point.
Yeah.
But it's not to say that it isn't resetting at that at the end of this month, because it is resetting. But it's a fair point. I just figured they were just heard the data point wrong. That has to be what it is. That's the only bond out there,
Yep.
and it's limited to 10,000. Or guess what we would be doing? Yeah, we would be doing that all day long, right? Yeah. In $1 billion, we'd put it there tomorrow. So there you go.
And it is kind of a clunky looking website. So when you go there and you think it's not correct, it is Treasury Direct, I think .gov, but search by I-bonds and it should take you right there.
Yeah, I think it just shows government doesn't always do things really well. Maybe no, even websites.
Right.
Yeah. Anyway, yeah.
All right. Any other questions? Oh, we have a hand up here. Let me.
Okay.
I'm going to do this and unmute him. Whoops, where'd he go? You know what? Raise your hand again. I'm sorry. It dropped you off my screen. Please put your hand
It
back.
was Mike, not Mike alone. Mike A.
There he is. Okay. All right, Mike. Go
Okay,
for it.
I think I'm unmuted.
There you go.
Hey, Dave, thanks for having these Zoom calls. These are fantastic.
Well, thank you.
I really appreciate it. But, earlier you mentioned that you were worried, but we've seen this movie before. We know the outcome, whether it lasts 1, 2, 3 years. We know we're going to come out of this. So my thought is put more in dollar cost average, and take advantage of it. Am I wrong?
No, not at all. This is where you really make the money, as that one screen showed, is in a bear market. We just don't know it at the time because our accounts are down. But in that same process, you're saying, I'm simply gonna find some other money here. Maybe it's out of a safer investment you have, right? That hasn't gone down. We literally, in our income portfolios, there really are investments that are up for the year. I know it's hard to believe, and I don't really want to run down that road. But you could shift, and I think it'd be a wise move, especially if you're thinking long-term, shift that money from one account that's doing okay, or one investment, and shift some of it and move it over if you're saying I'm fully invested. But if you have cash and you're sitting on it, to me, that's just doesn't make any sense. To be worried about Amazon down 35% going down 40 misses the whole point. It's like saying, as a human being, I can't stand it when I don't catch the exact bottom. Well, I'm sorry, human being, get used to it because you never do. And you're not a loser for buying down 35 just because it goes a little lower, right? If you're buying high quality, and that's the only thing I would say. There's a lot of low quality stuff that's been blown up in this market. And initially, some of that lower quality stuff was good to buy on a dip. Well, we completely said that we have to make a shift on this. And we are only going to go with quality because, to your point, what are you worried about? I am worried about a fundamental shift in our economy, back to inflation for a long period of time. And the answers coming from this administration, honestly, are more inflationary, not less. And for whatever reason, they don't make mistakes. So they're not changing their mind on energy policy, which is filtered all the way through our economy. We can't drive electric cars. We can't all right now, and the grid won't handle it. But the point is, we still have a lot of transportation needs that are a combustion engine. We need to solve that problem and keep working towards green energy, but it's not going to be. Anyway, my point is they're not solving that problem. So I do have my eyeballs out over the top and worried about the confidence in small business. As far as big business and buying the great companies, I am not. Hopefully that clarifies it a little bit.
Okay, yep. I do work for a large retailer. I'm out east in Massachusetts where I work, and I can tell you, I'm a buyer for water and paper products, paper towels, toilet paper. Dave, we can't order enough. We are screaming for that product. I mean, we're on the phone daily with our vendors. This is above and beyond what we've done in the past. We're not just playing catch up with COVID. This is extra demand that we are seeing, and it is through the roof. Anyway, then that's a side note, but
no, it's a good data point, Mike. It really is.
Yeah, it's, but I'm about 3 years away from retirement. I'll hold out through this market when it goes back up. But when that happens, when I get out of investing in growth stocks and I come to you or whoever, do you switch my account to income accounts like dividends and stuff? Does it completely switch over?
Yeah, it doesn't completely switch over. It's a really great point. We don't completely switch over. It's a transition. It's not an end point, it's a change point. And my belief has always been, because it's never changed data-wise, that you should have growth, but most importantly, growth of income in your portfolio. The core of a portfolio, stability-wise, growth-wise, income-wise, is those great dividend payers. And it sounds boring, but buy the Johnson & Johnsons, and in this case now, not so boring, are the apples, okay? Because they're paying dividends. Microsoft
Right.
pays a dividend. And although they have super high growth, we want to have some of that in the portfolio. You're not going to see Amazon in a lot of income portfolios, but you will see Amazon represented in some growth exchange traded funds, growth funds that are in retirement, because one thing that I learned is a reservoir of money is not just the rainwater that comes in consistently, okay? And that's important. So we have portfolios designed for anything between 3 and 5%, 2 and 5% income is just like, I just want to take my income and we design it to be providing around, say, 3. If you need more, we're going to take that growth piece occasionally, and we're going to sell it to replenish. I call that the snow melt. We call that the snow melt.
Yeah.
So when times are good, that's what I'm saying. We're planning on the next bad time. You trim off your growth that's gone. You trim it off, put it in the reservoir. Doesn't mean it's in cash, okay? But it's in lower volatility or no volatility investments, depending on the market conditions. Again, if I'm earning less than the inflation rate on bonds, I don't own them. That's not trying to make an interest rate assessment. That's simply saying, why do I want an investment that doesn't work? It makes no sense to me. Yeah, we want a 60% stock, 40% bond portfolio at 1.5 on a 10-year treasury guarantees that 40% of your portfolio is going to lose money. That's not an interest rate statement. That's a fact. I think that's the silliest thing that people continue to hang on to is a 60-40 portfolio. We may go back to it, but if you've been sitting through that for the last 10 years, oh my Lord, I don't know how you're taking income to keep up with inflation. You're not. We're running backwards. But the transition includes a smaller amount of growth transitioning to dividend paying stocks that raise their dividend, some of them crazily fast, like Microsoft and Apple. And maybe you also have growth. Who cares? I just want growth of that income in addition to some high yielding, hardly growing things to bring that income into the portfolio.
Okay. And then just one more question, Dave, and I apologize for taking your time and everybody else's time. But so when I am drawing the income in retirement, do I really worry so much about what the market is doing? Is that income going to be consistent throughout the?
Okay. Yeah, you're a perfect straight man, so I'm glad you're there. Okay, that's great. Great question to ask. So, Mike, the answer is I wish everybody would just say no and they would focus on the income. We can't, and that's because we pick up our phone and go, oh, well, the market is X. I'm playing around a golf and it's like, yeah, what's the market doing, Dave? I don't know. I'm not sure. I haven't checked it. You check it. Everybody checks it. Or how did it do yesterday or whatever. Of course I check it. I should check it. You should never check it. There's no reason to check during the day. It's irrelevant. Procter & Gamble paid 1 penny per share per quarter. A soap company, for crying out loud. Okay, I know they expanded into diapers, but how many iterations of Tide can you have? Okay, from a pod to a bucket of it, it's still Tide. That's what it is. And that's what Procter & Gamble did 100 years before 1970. So it's not like you're buying a new company. A penny per share is now over 70 cents per share per quarter, a 70-fold increase in income. I told you nothing about the stock price, but I promise you during that period, the stock went down a lot, even as the income went up. Procter & Gamble trading down to $90 or up to $180 is irrelevant to what they're going to be paying in their dividend. That's up to cash flow. They're a cash flow king. They're doing great. And I'm not saying their stock is cheap, but that's what you're looking for.
Okay, perfect. That's what I needed to hear. So, yep. Okay. I appreciate your time. Thanks, Jennifer, also.
You're welcome. Any other questions? You're good, Dave.
All right. Hey, thanks everybody. I sure appreciate you tuning in. If you need anything, give us a call. We love doing these. And also don't forget, these are out there on the YouTube channel, Petso Financial. If you missed the last one or the one before, catch up. Catch up. We're out there. It's Petso Financial. And if you subscribe, this is very important. If you subscribe to our channel and click the box for notifications, if you happen to miss one, you will be notified that there's a new one up. in case your email goes to spam or something terrible like that. Anything else, Jen?
Nope, I think you're good.
All right. Have a great day, everybody. And thanks again for tuning in. And thank you most of all for being our clients.